Housing costs have been one of the #1 reasons why we have an inflation problem here in Australia. But is this trend about to reverse? In this video, I'm going to show you really important lead data that showcases that the cost of construction is coming down and the cost of renting a home is also coming down. These two little bits of information are so large and can drive down inflation so much that it actually puts us back in the RBA's inflation band alone. And what that means is interest rates can start coming down sooner as a result. Specifically, I'm going to go through how we measure inflation, what housing has done to inflation in recent years, and why inflation is going to come down because housing costs are coming down. If you're interested in my thoughts, definitely keep watching and hit that subscribe button below. Hi, I'm Reedham Syed, ex-Treasury economist and now 6 times top 100 mortgage broker here in Australia. I work with thousands of property investors all across the country, helping them build, grow and scale their property portfolios. The way we measure it in Australia is by using a basket of goods and services and tracking how the prices of these goods and services are moving every month and every quarter. If the price of these goods and services that are weighted increase by a lot, that will feed into the inflation data, and if they're not rising at all, then inflation will be zero. And one of the big myths to dispel here is housing is measured by how fast house prices are rising. That actually barely feeds into the CPI at all. If you paid $1 million for an old property and now it's worth $1.2 million, that actually isn't in the basket of goods and services. This pisses a lot of people off because they're like, housing, I just paid an extra 20% for my house, so that should be part of the inflation story, but it isn't. Here we have the full basket of goods and services and the weighting each has. It really reflects our lives. That's what it's supposed to do. The CPI is really measuring what we all spend our money on, weighting it by the level of expenditure that we have on that individual item, and then tracking it. We spend about 15% of our money on food and non-alcoholic beverages. Australia, this one's a very special and unique one for Australia. We spend 7% of our money on alcohol and tobacco. Good on you, Australians. That's crazy high. Clothing, 3%. Housing, 23%. Really, really high. Furniture, furnishings, household equipment, about 8.5%. Health, nearly 6%. Transport, nearly 11%. Communication, 2.3%. And there's a whole bunch of different things that we spend on. Recreation, 12.8%. That makes up how we're spending our money. What you can see here is housing dominates the CPI basket, and rightly so. And recently, this is what has been contributing to inflation. So what exactly is housing? So I've already said that it includes rents and it also includes the price of new dwellings. Combining these two, you get the majority of this 22% figure. Now, the new dwelling purchase price, a better proxy for it is the cost of construction. When the cost of construction goes up, the price of a new home goes up. That's why you can use the cost of construction as the guide to work out what the new dwelling price inflation is. So this leads to the question, how much has housing been contributing to inflation in recent times? In the latest quarterly inflation data, I'm using a forecast here from Westpac. They have broken down the latest forecast inflation quarterly data and what's making it up. Check it out. Housing makes up 0.3% of the quarter-on-quarter inflation figure. If you extrapolate that out, over 1.2% of inflation, that is, more than a quarter of it is being driven by housing inflation itself. So it is really driving up our CPI figure and as a result, holding interest rates really high and potentially even causing interest rate increases. I'm recording this video before the RBA's rate announcement on August the 6th. What have we got here? We have a clear picture. Inflation is being dominated by housing measurements. So when housing measurements change, the inflation story will change as a result. When it makes up a quarter of it and it's rising really, really quickly, it is dragging the entire index up and it's creating a problem for the RBA. But why am I suggesting that it's going to fall? It's a bit of a crazy idea. If the latest data set has it rapidly high, why am I saying that housing inflation is going to reverse and go backwards? It's because I am looking at lead indicators to housing costs. Specifically, I'm looking at two lead indicators. The first is asking rents. Now, the actual CPI rents that are in the data, they are correlated with the asking rents that people who own properties, landlords, are charging and asking for. When asking rents go up, you're going to see CPI rents also increase. That's in this chart here. It correlates with each other. There's been a little bit of a difference recently, but you can see the increase is matched with an increase in the CPI rents. They track each other. The SQM research data tracks the CPI rents with a little bit of a lag. But here's the latest data set for SQM research, and what does it tell us about asking rents? If you look really closely in the data here, the 12-month change for rents is about 10%. Crazy high, and it's dragging inflation up. But the latest quarter, what is happening in the last 90 days, we can see a quarter-on-quarter change of next to nil. And looking more specifically at Sydney rents have stopped rising altogether. So this recent trend of this huge surge up in rents, that appears to be going away. Now, it's too early to say that's over, but the data suggests that rental prices have stopped increasing at the rate that they were and may have stopped increasing at all. That would be a huge turnaround to the biggest component of CPI itself. And here's the second bit of data that really matters here. The Cordell Cost of Construction Index. CoreLogic measure exactly how much build prices are going up by every quarter and have been doing it for a really, really long time. And if you check out this article, it says this specifically. Construction cost indexes released by CoreLogic Australia show that construction costs are rising at their slowest pace in 20 years. This is the complete reverse of about 18 months ago, when they were rising at the fastest pace on record. So you have a crazy lead indicator here. Rents have stopped rising after a rapid surge that has driven this huge inflation surge in housing. And then on top of that, you have new construction inflation being at its lowest levels in 20 years after the rapid rise last year. We have what we need. We have the key metrics in inflation coming down, and that is going to drive down the CPI over the year ahead. This is fairly new data, and if the weighting holds true, if these lead indicators continue to go in this direction, then the inflation story, that problem, will all but disappear because you're taking over a percentage point away, and we're less than a percentage point away from where we need to be. Inflation's at roughly 4%, housing makes up more than 1% of it, and that housing 1%, that's about to go close to zero in about 6 months' time. But what does this all mean? It means that inflation is coming down pretty fast over the next 12 months from that 4% level to closer to 3%, and that is going to take pressure off the RBA. And for you, as mortgage holders, property investors, and those with an interest in the economy, it likely means that rate cuts are coming, and they might be bigger than people expect. Housing is such a big contributor that it can make a meaningful difference to the entire trajectory of Australia's interest rates and inflation for the year ahead.